My name's Grace Swigert, and I was in charge of production for the Erie Company.
Hello, my name is Carly, and I worked alongside Ashley to create the marketing decisions for the Erie Company.
Hi, I'm Ashley Sign, and my role in the Erie Company was to assist with marketing and sales promotion.
Hi, my name's Hayden Smith, and I was in charge of the research and development for Erie Company.
And I'm Morgan Williamson, and we are the Erie Company.
The first thing I'm going to cover is the introduction. This overview of the Erie Company will consist of 7 sections, starting with an overview, a segment share analysis, our research and development strategy, a marketing strategy, our production and strategic approach, our finance and investments, and then finally, our conclusion. To begin, the Erie Company has a total of 7 products spread out over 5 different primary segments. Our first one, Eat, is a traditional. Our second, Ebb, is our low. Our Echo is our high. Our Edge is our performance. Egg is our size. We also have Earn within the size segment, and then Elf as a high segment. Before we delve more in depth on some of our overall statistics and path forward, I want to provide a general overview of some of Erie's decisions and analysis over the last 5 weeks. So our beginning sales for round zero were, as everybody else's were, $101,073,437. After the conclusion of round five, our total sales grew to $193,127,279, representing a roughly 91% increase over the course of 5 years and the second highest market share within the simulation. Between rounds 4 and 5, the Erie Company experienced a 4.8% net growth in sales, even with our emergency loans. I kind of build off of it in the first one, but starting with our market share, in the conclusion of the 5th year, we represented a 20.27% sector market share. It was the second highest among all companies and less than 1% behind the market leader in terms of share. Third, in demand, Erie recorded a contribution margin of 22.5%. Our products Eat in the traditional market and Egg in the size market had the highest number of units sold across all of our competitors, demonstrating a strong demand for our products by consumers.
Hello, everyone. My name is Carly, and Ashley and I were responsible for managing the marketing decisions for Team Erie throughout the first 4 rounds of our CapSim simulation. Because Erie oversees a large portfolio of 7 products Eat, Ebb, Echo, Edge, Egg, Earn, and Elf, our marketing strategy had to work across multiple segments at once, balancing price, promotion, sales budget, and forecasting. This meant every choice had to consider not just one product or one segment, but how each decision would affect the overall brand image and demand for all 7 products. We began in round zero with a completely level playing field. Every company, including Erie, held about 16.7% share in each segment, and no products had any real awareness or accessibility. That meant consumers essentially didn't recognize our brand yet. At the same time, total demand across all segments was 22,800 units, so we knew there was plenty of room to grow if we could make Erie visible early. This baseline shaped our strategy for round one. We needed to spend aggressively enough on promotion and sales budgets to quickly build awareness and accessibility, which are the foundations of long term demand. Without these two, even well positioned products won't sell. In round one, that became our primary marketing objective. We set promotion budgets high across all 7 products to rapidly increase awareness and sales budgets to start building accessibility, which grows cumulatively over time. As a result, several Erie products immediately began gaining traction. Eat rose to 13.9% total share, Edge held a strong 17.9% share in the performance segment, and Egg reached 20.1% in the size segment. These early jumps confirmed that the investment was paying off. Round one in Capson is often the foundation for long term competitive advantage, and we made sure each product received enough funding to be visible and accessible early in the game. Moving into round two, the total market share expanded to 28,961 units and competition intensified. With awareness built, our next priority was tightening pricing for each product based on the segment buying criteria. Because Erie operates in all 5 major segments traditional, low end, high end, performance, and size this required adjusting multiple prices to stay within or very close to customer expected price ranges. At the same time, we improved our forecasting accuracy, which is critical when managing 7 different demand patterns. Even with stronger competitive pressure, several products continue to perform well. Egg reached 14.1% share in the size segment, Edge maintained 12.4% in performance, and Echo held 11.5% in high end. These results showed that early awareness gains were carrying us forward and that our price adjustments kept us competitive as customer expectations shifted. By round 3, the market grew again to 32,691 units, and by this point, our marketing decisions began to compound. With consistent promotion and sales budgets, customer familiarity with Erie increased, and our products began carving out strong positions in several segments. Eat increased to 24.1% share in traditional, becoming one of our strongest overall performers. Egg remained highly competitive with 20% in size, and Edge climbed to 18.7% in the performance segment. Even Ebb, though weaker in R&D specs, held a solid 18.9% in low end because our marketing spending helped compensate for its technical limitations. Round 3 was really the point where we began to see how sustained spending on awareness and accessibility can elevate even mid-tier products within a segment. Entering round 4, the total market expanded to 36,939 units, and companies were spending more aggressively on marketing across the board. Our goal this round was to maintain customer awareness and accessibility while keeping price points aligned with shifting customer expectations. The results show that the strategy worked well. Eat dominated with 29.8% share in traditional, reflecting both strong awareness and solid forecasting. Egg achieved 21.4% share in size, and Edge reached 21.6% in the performance segment, both strong positions in highly competitive spaces. Echo also performed well with 12.6% of the high end segment, and even Ebb preserved visibility in low end at 8.2%, despite its lower spec design. Across all 7 products, consistent marketing investments allowed Erie to hold or expand its market presence as the simulation progressed. Overall, our marketing strategy across the first 4 rounds followed a clear progression. In round 4, we focused on raising awareness and accessibility so our products would be recognized. In round 2, we refined our pricing and improved forecasting to better match customer expectations. In round 3, we consolidated our segment positions as awareness and accessibility matured. And in round 4, we worked to maintain and stabilize our product positions in the face of increased competition. Marketing played a major role in making Eat, Egg, and Edge some of the strongest performers in their segments, while still supporting the rest of our 7-product portfolio.
Hi, my name is Hayden Smith. I was primarily in charge of the research and development for Erie Company throughout the simulation. And these are the 2 main points that I was in charge of within the company throughout this time period. So, starting with performance and size, I really tried to adjust these metrics accordingly with the proposed shift rates listed within the industry conditions report as well as the capstone courier. Um, I felt like it was important to stay up to date on these decisions and make sure that I was adjusting these 2 metrics every single year in order to keep up with the changing customer demands throughout the simulation as well as the shifting market segments as well. And looking at the mean time before failure, I really decided to maximize the quality of all of our products right from the start. Just kind of understanding that each market segment preferred different levels of quality. I wanted to make sure that we were providing the highest possible quality that our customers would still buy within those market segments. So I just went right from the get go and started adjusting the quality to the highest possible value for the first couple rounds and first years of production, just to make sure that I helped set the standard for our company as high as I could right away to ensure that our customers understood right away the kind of company that we would be and the kinds of products that our company would produce. And looking ahead for the rest of the years, the MTBF values remained primarily unchanged throughout the simulation. And this was just in order to keep up with our high standard of performance and again, to remain consistent for what our customers knew they were getting. So, in this slide, I will be discussing the two new products added within the company, as well as our future plans for research and development moving forward beyond the 5 years of the simulation. Um, so, looking at the two new products I had introduced into our company's inventory, I really wanted to expand upon two market segments that I felt the company needed to expand into and help create more market share percentage for those specific products. The two products added in the third year of the simulation were Earn in the size segment and Elf in the high end segment. And again, these were added in, and I believe they helped give us more opportunity to gain an increased percentage of market share moving forward. And looking at the future plans for research and development for Erie, just looking ahead for the future of the company, we plan to expand into every single market segment with additional products. I believe doing this will ensure that our company remains aligned with the strategy of broad differentiation and becoming a strong competitor in each market segment while maintaining the same high quality products. The future plans of research and development are definitely costly, but I firmly believe it will help position the company for continued success and efficiency in the years to come and will help keep the company more competitive moving forward.
Hi, my name is Ashley Sign. I worked alongside Carly with coming up with our marketing strategy for Erie Group. Two essential components of our marketing strategy were competitive pricing and effective sales and promotion. To accomplish the objective of competitive pricing, an analysis of consumer preferences and competitor pricing was completed after each round. Based on the price points of similar products with our competitors in each target segment, we were able to set prices competitively to ensure continued sales growth through each round. An indicator of the brand strength for this company that's evidenced by our pricing data is that by rounds 4 and 5, our prices remained stable, meaning we were able to avoid a loss in revenue by not having to cut our price to compete in these markets. Our sales continued to grow through round 5 at these stable prices. For the promotion piece of our marketing strategy, our team analyzed each of the target segments as well as consumer preferences and budget trends from our competition. We were able to identify a need to increase our promo and sales budgets during the last two rounds in order to gain a higher level of customer awareness and accessibility. This slide shows each of the top performers and our promotion budgets in these target segments. Eat was a number 1 performer for market share in the traditional segment. Edge was a number 2 performer, and Egg was a number 1 performer in its target segment of size. Looking at those same 3 top performers, you can see that our sales budgets for Eat in the traditional segment and Edge in the performance segment, Egg in the size segment, remained unchanged from round 4 to round 5. However, our accessibility rate did increase. This is also attributed to the brand strength of this company, as well as the other effective advertising and marketing strategy techniques that were implemented. Because of our brand strength and organizational performance in the segments of traditional, performance, and size, Erie Group finished round 4 as the number 2 holder of total market share with 18.88%. During the last round, we continued to experience sales growth and increased market share, which led to a total market share of 20.27%. This was less than 1% from the top performer in our industry.
So on this slide and some of the upcoming slides, I wanted to outline some of our core principles behind our production strategy and just our general production strategic approach. So firstly, we focus heavily on automation. For us, higher automation meant directly reduced labor costs, which created a more stable margin for us, and it also just created more consistency with our products. Secondly, we wanted to adjust our capacity and inventory to match them up as best as possible, and we did this based on real market indicators. This just ensures that we're able to meet demand without overproducing or tying up capital and having so much extra inventory sitting in our storage. Also, we wanted to prioritize avoiding stockouts as much as possible. Because demand for Erie products is just so strong, keeping high availability for our products was essential to capturing just the full revenue potential for us. And finally, to maintain cost control, we limited our reliance on overtime hours as much as we could, and instead we really focused on operational efficiency. And finally, we tried to place a strong emphasis on matching capacity with actual production needs so that we could operate as efficiently as possible without wasted resources. So next up for production, this slide shows our production versus capacity levels over the first 5 weeks. And this alignment tells us a lot about how our operations were actually functioning for the Erie company. So as you can see in the graph that I took, our production levels closely track our available capacity. So for us, this means well-managed operations and points to strong demand forecasting. We're using our manufacturing assets efficiently with very little idle capacity. And for us, that means the money that we've actually invested into our equipment is actively generating output rather than just sitting around collecting dust. Also, minimal wasted capacity translates directly into lower per unit costs and stronger contribution margins. And overall, this level of alignment demonstrates a really strong planning process on the leadership side and cost control, which is key for long term competitive performance. Another important note is that this is an early indication that our products are ready to reach operational maturity, which is really important for investors like you looking into the future. So this next slide highlights some of our major takeaways from our production actuals that we saw through the simulation. So first, important to note is that we consistently maintain high levels of units sold across all Erie product lines. This is one of the most clear indicators that we have a strong ongoing demand from our consumers, and it also reinforces that belief that extending our capacity will be worthwhile because we will have more and more demand in the future. Secondly, we continue to see healthy contribution margins throughout the simulation, especially from some of our more mature products. And now Erie is very well established, and many of our products are benefiting from stable material and labor cost. Also, automation continues to be a central strength in our production strategy. As we said in the beginning, higher automation levels are directly supporting efficiency, cost control, and lowered labor costs, And fourth, our plant utilization, which varies by product, but overall it remains high, which shows efficiency using our plant resources. Many Erie products run close or above full capacity, which suggests strong demand and justifies greater future capacity expansion. Altogether, these results demonstrate operational discipline and strong alignment between our demand, our cost structure, and production capacity. So on this slide, you can see kind of our forward-looking statements and what we think production will look like in the future for Erie and kind of the way we view it now as a leadership team. So looking forward, our focus is to really scale production in a strategic and sustainable way. Currently, our high utilization levels are clear evidence of strong consumer demand, and we really want to capitalize this. So we plan on expanding capacity as much as we can while keeping utilization high to maintain our overall operational efficiency. A major part of our future strategy is to invest further in our automation. Like we said in the beginning, we believe that is one of the most successful ways to get us to our higher capacity levels. Increasing automation by even half of a point, like I mentioned, half to one, as you can see on the screen, over the next several weeks and years will reduce labor costs, improve reliability, increase consistency even, and widen our margins overall. So as automation increases, we expect our need for overtime hours to decline significantly, which will also help our future production.
Our total stock price finished at a price per share of $1. Although it's not the result we were hoping for, I still think there are some benefits that we can draw from this image. First off, our market cap finished at $2 million. It's roughly middle of the pack and not exactly what we wanted, but I think the most important thing to realize is our shares. We have a total share amount of 2,199,344. This is the lowest amount of shares throughout the industry and all of our competitors. If the right approach is taken in the future and we leverage it correctly, due to our low shares and scarcity, we could propel Erie stock price higher than all of our industry competitors. So, one of the biggest things that I wanted to talk about was our emergency loan. During the final round, we took an emergency loan of roughly $57,480,312. We leveraged this as a deliberate strategy to maintain our production, protect our market shares, and prevent costly stockouts that could have had more drastic effects in terms of our demand. By accessing this capital quickly, although not ideal, we ensured our operations were uninterrupted during the high demand cycle and positioned ourselves for a stronger profitability in the future. In terms of a long term outlook, this move ultimately preserved our current market share, which we finished second in. Without it, we may have faced production delays, declines, or capacity shortages that could have reduced our market presence. Instead, we posted over $193 million in revenue, a result that I don't think would have been possible without this funding. It reflects a kind of risky choice, and a bold one at that, to prioritize the growth of our company over contraction. It allowed us to keep our strategy going and keep investing in marketing and production and other facets of business while some competitors pulled back. And as a result, we protected our demand, and we hope to go into future years with a stronger momentum in our increased return year over year to make sure that we don't have another emergency loan in the future and we can grow to success. Now, we take a forward looking approach and talk about some of our financial forecasts for the future. Looking forward at our sales in the final issue of the Capstone Courier, Erie was only behind the Andrews Company in terms of overall sales. Understanding that we had to use our emergency loan, we firmly believe that the company will further innovate and increase revenue by utilizing this emergency loan to propel us into the future. In terms of profitability, our overall net profit was unfortunately reported as a negative, but if you consider all the expenses and changes made to our organization and our financing and marketing, we expect to break even and even push further into profitability and become the most reliable choice for our consumers and our customers in the years to come. As we look forward into future years, the development of our company, we plan to grow and continue to grow our company financially by reducing labor costs and unnecessary expenses, increasing automation, and making up for any past mistakes. And we want to learn from them. That way, we can become more successful in the future, both for the Erie Company and to provide our consumers with a wonderful outlook. In conclusion, our team feels very strongly about the growth and the future of the Erie Company. Our current market share and growth year over year represent a strong demand for our products, and going forward, we hope to avoid more emergency loans, raise our stock price, and work to make products more accessible for every consumer. Thank you for watching our presentation. We appreciate your time and your consideration. We hope going forward that you'll continue to place your trust in the Erie Company, and we wish you all a wonderful day.